Hello, my name is Drew Cohen, and today we are going to talk about what really is a hedge fund. Now, if you're not clear, it's not your fault because it is usually very poorly explained and also poorly defined. Now, I worked at Goldman Sachs where our counterparts were hedge funds. And so I learned about some of the inner workings of the hedge fund. Now, currently, I also run Speedwell Research, where our clients are hedge funds, and I've sold investment research to hundreds of them. And so I've had a lot of interactions with analysts and portfolio managers, so I understand not just the structure of the funds, but also how they work. Now, in this video, we will break down what a hedge fund really is, as well as different hedge fund types, and talk about a lot of their different strategies so you can gain a much better understanding of what a hedge fund truly is. Now, to begin, let us go back to 1949 when Alfred Jones created the first ever investment partnership that shorted stocks. Now, for those that need a reminder, when you short a stock, what that means is you're borrowing a stock that you don't own, so you borrow it from the broker, and then you sell it and receive the proceeds up front. Then you later on buy it back, usually, hopefully, at a cheaper price. And so you make money when the stock price goes down. That is the idea of shorting it. And so he was the first person to ever go long stocks, which means you own them outright, as well as short stocks, which means you are selling them, just as I described. And that is what created the first ever hedge fund. The idea was that he was hedging his risk. So he would go long certain stocks and short other stocks. So if the market as a whole fell in value, his shorts were likely to benefit. And so that helped his portfolio not drop as much as the market as a whole. Now, there's a lot of different ways you can implement this, and we'll talk about a lot of specific strategies, but I want to first talk about this really important idea of relative versus absolute returns. Now, most times when you think of an investment fund, you think of them as their goal being to beat the market. Now, usually the market's defined as, the S&P 500, which of course is just an index of 500 of the biggest stocks. And it's people's job to try to do better than that through superior stock picking. That is what is called beating the market. And if you're able to do that, then it's usually said you have excess returns, or if you want to be fancy, it's also called alpha. And so, simple example, the market does 10%, this investment fund does 20%. You take 20% minus 10%, that means they outperformed by 10%, or you could say they had 10% alpha. Now that is a fund that is being judged on a relative basis. That is because you only know their performance is good once you judge it relative to a benchmark. Now they can pick whatever that benchmark is. Again, the S&P 500, really common one. They can pick the MSCI Global Index. If they're in the UK, maybe the FTSE 100. There's lots of different indexes you can pick from. The idea though is that if I were to tell you this fund returned 15% this year, they wouldn't be able to say it's good or bad until you know what the benchmark did too. If the benchmark did 20% that year, that was bad. If it did 10, it was good. That is what a relative fund is. Now, what an absolute return fund is a fund that aims for a certain return, agnostic of whatever a benchmark does. So very often, pension funds, endowments, they kind of assume that they can get a 7% return over time. And so a lot of hedge funds will aim for at least a 7% return, regardless of whatever is happening in the market. And if that is the case, then that is an absolute return fund. And so if the market was up 10% and they only did 7%, they would say, hey, we did our job. We got that 7%. If the market was down 10% though, they would also still need to say, hey, we got that 7%. So the idea is regardless of what happens in the market, what happens with any benchmarks, they're just trying to hit that specific return number. Now, a lot of funds are kind of a mix of both of these. And the reason why that's still kind of honest is because when you are hedging, you are basically giving up potential return in good environments to be down less in bad environments. And so just to kind of elucidate this, a very common hedge would be to just short the S&P 500. And so you may have a long portfolio of, let's say, $100 a stock. Then at the same time, you short $100 of the S&P 500. You could do that usually through futures or something like that. When you do that, what you're doing is you're making your portfolio what is called market neutral. And that is because if the market drops, you have a hedge to protect your downside. Then you make money by having superior stock picks. That would be something that is market neutral. And so all of their returns, they would say, are, pure alpha. And even if they're only able to get a couple points of return, they'll leverage it up a lot so it's more. And we'll talk about that momentarily. And so that is the idea of absolute return. They basically are saying the return we did achieve, we did it with a lot less risk. And so that is kind of the definition of a hedge fund. It is any investment partnership that attempts to minimize against specific risk. Now, generally speaking, it will be sort of market risk, the stock market going down, but it could be any other risk. You could have a fund say that we're hedging against currency risk. Maybe it's a Latin American fund, they buy a Latin American stocks, and the only hedges they do are to hedge against South American currency inflation. That could still be considered a hedge fund. Maybe not in the most traditional sense, but they could still fit the bill. Now, I want to talk though about some of the most common sort of models of hedge funds and give you some sort of industry lingo into how they work. So the first hedge fund kind of category is going to be a long short equity fund. This is very similar to that first ever hedge fund I described. They'll go long a certain amount of stocks and go short another amount. If they want, they could do what is called have a market tilt. So they may say that they're very optimistic about what's happening in the market. So they may go 120% long. And so that means that they may have $120 going long and $100 going short. They could also have a market short tilt, which would mean that they're a little bit more short than they are long. And so they would benefit if the market goes down. This is kind of the gist of what a long short fund is. And of course, equity denotes the fact that they're just focused on equity. Now, kind of a subsegment of this, but it's actually one of the most common hedge fund models, is called the multi-manager model. Now, in the industry, it's also called a pod fund. And so that is everything like Citadel, Millennium, Balyasny, Point72. All of these are pod funds. And it is called that because they have a lot of different portfolio managers that each get their own pod or profit and loss statement. So if you were a portfolio manager at Citadel, they may say, here, you have $200 million to invest, and you've got to balance your longs with your shorts. And so you have to have your book be both as short as it is long, or you may be allowed to take a little bit of a tilt. And so if you're very optimistic on your sector, let's say you cover semiconductors now, you may say, look, I've never been so optimistic on this sector in my life. I don't want to be that short. Let's be a little bit more long. He may agree. And so you could kind of tilt the portfolio to be a little bit more long than short. So a fund may have dozens and dozens of different portfolio managers, each assigned to a specific sector. The reason why it's a sector is because they want them to be expertise in that industry, know it better than anyone else, so they know which stocks to go long and which ones to go short. Coverage may be sometimes as small as, 10 or 20 stocks. It could be much more, it could be hundreds, but the idea is that they want them to be experts in their field and they want to narrow it as much as possible so that they have that one individual that knows that sector and knows why those stocks move better than anyone else. And kind of as I'm speaking, you maybe are picking up, this does tend to be more short-term oriented. A lot of hedge funds do have to report returns, not just on a quarterly basis, but on a monthly basis. And so they do have a lot of pressure for performance to always be good. And as a result of that, they tend to be very short-term oriented. Now, that's not necessarily a problem for this sort of model because they are absolute return focused. So within this model, you may have your longs return 10% and your shorts are, a negative 8% to you. And so you only return 2%. In your P&L. It seems pretty bad, but with, 6 times leverage, that scales up to being up 12% on the equity portion of your portfolio. And so I'll explain that leverage aspect in a moment. But what I want to just emphasize right now is that this fund will have all of these different managers responsible for different sectors, and then it scales up to the fund. The fund manager then can say, I want to be more long this sector, more short this sector. Maybe overall, though, I still want to have a positive market tilt because I think the market's going to be very strong. They get to make all of these decisions. And so what a semiconductor analyst may do is do something that is called a pair trade. What he is doing is he's trying to pair one stock that he thinks is really strong and going to outperform with another stock that he thinks is going to underperform. And so maybe he really likes Broadcom. And so he's saying, we're going to go long Broadcom. And at the same time, we're going to short Synopsis or something like that, just to throw some names out there. And I think that if the market goes up, Broadcom's going to go up much more than Synopsis is going to go up. Whereas if the market goes down, I think Synopsis is going to go down much more than Broadcom because Broadcom's a superior stock to Synopsis. And so that is just an idea of how they can structure some of these trades. That's called a pair trade. However, these funds don't just need to hedge by shorting stocks. They could buy futures, they could buy options. And so they do have a couple other options of how they could hedge these risk. Now, that is what a pod fund is. Again, one of the most common sort of hedge fund models that at least has a lot of AUM and mindshare, but there's a lot of other ones. You could have a global macro hedge fund. They may not be picking specific stocks. They may say that we're going to go long a certain country and, buy their currency, and we're going to go short, the commodity export, something like that. They can structure their trades all sorts of different ways. There's also quant funds. Now, some of these kind of get close to what high frequency trading is, but sometimes what they may do is they may say, we're looking for different factors, but a lot of them do still have short exposure as well as long exposure. Now, there's also special situation funds. These could be funds that decide to short the equity of a business and buy the junior debt. So if it does go bankrupt, then in bankruptcy court, they could try to win something from the junior debt. That's just one example. You could also kind of have activist hedge funds too. Exactly calling these hedge funds, though, is a little iffy. It depends, though. It's not the clearest sort of type of hedge fund, but they could potentially, buy the equity and then have a market short or something like that, which does give them some sort of downside risk mitigation. And then lastly, there's also arbitrage funds. And again, few sorts of different ways you could do this. Mergers and arbitrage, very common one where, a company announces they're going to acquire another company and there's still a spread between the price they said they would pay for it and what it trades at. So they could go long the company that's being acquired and then short the company that is acquiring and kind of hope for that spread to close or just hold it until it actually happens. Now, a lot of these strategies, though, rely on a lot of leverage. And so that is really important to understand. Now, in a hedge fund, there is a little bit of kind of natural leverage, we could call it, because when you do short a stock, you get proceeds up front. And so those proceeds being invested back into, a stock that's going long is kind of a way that you are naturally leveraged because you're borrowing money at the outset. Now, a lot of hedge funds, though, borrow much more than this. They're able to do this by going to banks and saying that, we're market neutral. We have all these shorts. Our portfolio is never going to be down more than, 7% in a month. Give us a lot of money because we're pretty safe credit risk. Banks that lend also usually have a trading operation. And so they'll usually sort of tie any sort of lending to, okay, well, you got to do your trading with us. And so they'll make money off the trading and, a little bit of money off the lending as well. And so that's why they are kind of willing to take this sort of risk with the lending, because otherwise kind of short of that may seem like it's pretty risky, but some banks still do it anyway. Long-term capital management is sort of this very infamous case of a hedge fund being able to get a lot of leverage. I forget the exact number. I believe it was over 30 times effective leverage at some point. And these banks were making very little off of them and they blew up. And so there is still a lot of risk involved when you are taking out that level of leverage. A lot of these hedge funds do a very strict sort of downside tolerance. So if a portfolio manager's portfolio is down, 7%, maybe if they like him, he has a good record, they'll give him another 2% to fall down. But if he hits that 2, they'll just liquidate the whole thing. If he's been there for a while, maybe they'll give him one more chance or maybe they'll just fire him. Very common for a lot of these hedge funds to fire managers in less than a year. And that's again, because they are very short-term performance oriented. And so if it doesn't work in the short term, you're out. And so it is a very tough way to sort of manage money, very high pressured. And then the goal is sometimes to even just get 1 point of, alpha, because when you are leveraging this up, it does become a much bigger number. And so the two big takeaways are that a hedge fund is any sort of investment partnership that has some sort of downside risk mitigation embedded in it. And then secondly, that you should always think in terms of absolute versus relative return. Because if it is absolute return, you shouldn't actually expect it to do as well as the market. And, a very simple explanation for this is, let's say in your own investment portfolio, you want to hedge it. So you buy some S&P 500 puts. That premium you're paying on the S&P 500 puts is going to be a drag on your return every day, every year. And so what you're doing there, though, is you're trading off some return for less volatility. And that is what a hedge fund is at its core. It is something that is willing to trade off a higher return for less volatility. And they will say that the return you're getting is lower risk and thus you should be happier with it. But that is basically what is happening. And a lot of times institutions are happier with that because they do expect in a down market the hedge fund to not be down, sometimes at all. But not every hedge fund is run well. There's lots of different examples of them blowing up for all sorts of different reasons. And so I hope this helps clarify, though, what a hedge fund is. If you want to continue to learn more about investing and business, though, make sure you hit subscribe because we got a lot more videos coming out soon. And if you have any questions, go ahead and drop them in the comments below. And it could be on this topic, it could be on any other finance or investing topic that kind of came up in the process of this video, and I will eventually get to it. Thank you for listening.